Warships can posture and planes can patrol, but they can return to port in days. Sovereign debt is different. It is heavy, slow, and public in the only language finance truly respects: custody and settlement. If you want to know whether a superpower is merely signaling or quietly preparing for a permanent split, watch what it does with the other side's government bonds. This week's U.S. Treasury data offers that kind of clue. Buried inside the Treasury International Capital Reports is a line that looks boring until you place it in context. China's reported holdings of U.S. Treasuries were about $688.7 billion in October 2025. That is far below the era when Beijing held roughly $1.32 trillion at its peak in 2013. In other words, the financial glue that helped hold the relationship together for years has been thinning fast. Here's why that matters. Large positions in sovereign debt can't be unwound quickly without consequences, and selling into a weak bond market often locks in losses. When a country with ample cash still chooses to reduce exposure, it's rarely a simple portfolio tweak. It's risk management for a world where assets can become leverage, or a liability, overnight under sanctions. Sovereign debt sits at the core of the modern global order because it represents trust extended across borders over long periods of time. Unlike stocks or commodities, government bonds are designed to be held quietly for years, sometimes decades. They anchor reserves, stabilize currencies, and signal long-term alignment between states. Because of this, changes in sovereign debt holdings matter far more than day-to-day market moves. Unwinding a large bond position is slow and costly. Selling too quickly can crash prices, push yields higher, and expose the seller to losses. Central banks understand this, which is why they usually rebalance gradually and discreetly. When sales accelerate during periods of market weakness, it signals urgency rather than optimization. This is what makes recent shifts so revealing. The global bond market through 2024 and 2025 experienced volatility, depressed prices, and rising yields. Selling during such conditions guarantees realized losses. Rational asset managers avoid that unless they face immediate liquidity needs or believe the asset itself has become dangerous to hold. China does not face a liquidity crisis. It continues to run significant trade surpluses and maintains deep foreign exchange buffers. That removes the most common explanation for aggressive selling. What remains is strategic calculation. In this context, reducing exposure is not about return. It is about control, jurisdictional risk, and preparing for scenarios where financial assets become tools of coercion rather than stores of value. The scale of China's reduction becomes clearer only when viewed historically. In 2013, at the height of financial integration between Washington and Beijing, China held roughly $1.32 trillion in U.S. Treasury securities. That position effectively helped finance American deficits while enabling Chinese exports to flood global markets at low cost. It was a closed loop that benefited both sides and kept global interest rates suppressed. Today, that loop no longer exists. With holdings near $688 billion, nearly half of China's peak exposure has been erased. This is not a marginal adjustment. It represents the dismantling of a financial structure built over more than a decade. Such a reversal cannot be explained by yield optimization or routine reserve management. What makes the move more alarming is timing. Much of the selling occurred during a period when bond prices were depressed and interest rates volatile. Selling under those conditions means accepting losses on paper. In conventional asset management, willingly locking in losses is irrational unless future risk is perceived to be far worse than current pain. China's leadership appears to have reached that conclusion. The U.S. Treasury bond is no longer viewed as a neutral reserve asset. It is seen as politically exposed, sanctionable, and vulnerable to external control. Accepting losses today becomes logical if the alternative is a potential total loss tomorrow under geopolitical escalation. To understand why U.S. Treasuries have shifted from asset to liability in Beijing's thinking, you have to revisit February 2022. When Russia invaded Ukraine, Western governments froze roughly $300 billion of Russian central bank reserves held abroad. Those assets were sitting in accounts that Moscow believed were untouchable. They were immobilized almost instantly through legal and financial infrastructure controlled by the United States and its allies. That moment sent a shock through every major capital that holds reserves in Western jurisdictions. For China, the message was unmistakable. sovereign reserves are only sovereign until politics intervenes. In a serious conflict scenario, legal ownership does not guarantee access. Assets can be frozen, seized, or rendered unusable with administrative speed. From that point forward, U.S. Treasuries stopped looking like a safe store of value and started resembling a hostage. If tensions over Taiwan or the South China Sea escalate into sanctions, Chinese holdings could become inaccessible overnight. In that scenario, even $1 trillion would effectively be worth zero. Seen through this lens, selling at a discount is rational. A 10 or 20% loss today is preferable to a 100% loss tomorrow. The liquidation is not financial panic, it is strategic de-risking. China is trading yield for survivability, accepting near-term losses to eliminate a vulnerability that could be exploited in a future confrontation. What makes this liquidation especially revealing is the speed at which it is happening. Central banks usually sell sovereign debt slowly and quietly. They break transactions into small pieces to avoid alerting markets and driving prices against themselves. The goal is discretion and stability. Recent data shows the opposite behavior. China shed nearly $12 billion of U.S. Treasuries in a single month, a pace that signals urgency rather than caution. This velocity matters because it suggests priorities have shifted. Market impact is no longer the primary concern. Jurisdictional exposure is. The objective is to move assets out of U.S. legal reach as quickly as possible, even if doing so means absorbing losses. That is not how a passive reserve manager behaves. It is how a state acts when it believes time is a risk factor. This urgency also explains why the selling continued despite unfavorable market conditions. Bond prices were already depressed and yields were elevated. Selling into that environment locks in losses, but it also accelerates exit. In strategic terms, speed outweighs price. When a country prioritizes removal over optimization, it reveals expectations about the future. China is not positioning for a return to financial normalization. It is preparing for a world where financial assets are no longer neutral and where delay itself carries unacceptable risk. China's exit does not happen in a vacuum. When a major holder sells hundreds of billions of dollars in sovereign debt, the question immediately becomes who absorbs the supply. Basic market logic says prices should fall and yields should rise until new buyers are attracted. In theory, China's departure should have caused a violent spike in U.S. interest rates. That outcome would have destabilized mortgages, banks, and federal financing. Yet the bond market has not fully broken. The reason is substitution, not stability. As China steps back, other actors are stepping in. Treasury International Capital data shows abnormal increases in holdings attributed to U.S. allies, particularly the United Kingdom and Belgium. This shift is not organic market behavior. These economies do not run the massive trade surpluses that once funded China's bond purchases. They lack the natural capacity to absorb such volumes without strain. What is happening instead is forced absorption. Allies are using leverage, financial engineering, and custodial structures to hold debt that the market no longer wants at current prices. The goal is not profit. It is damage control. Prevent a yield spike, preserve market function, and buy time. This transforms the bond market from one driven by economics to one driven by politics. Demand is maintained not by confidence, but by obligation. As China's selling accelerates, pressure shifts onto the allies, now acting as shock absorbers for the U.S. Treasury market. The United Kingdom's reported holdings have surged toward levels comparable with China's, despite Britain running persistent trade deficits and lacking surplus capital. This implies borrowing, leverage, and balance sheet stress, not organic demand. Britain is effectively straining its own financial system to stabilize another's. Belgium's role is even more revealing. The country itself is not suddenly wealthy. Its importance comes from hosting Euroclear, a major custodial hub for global securities. When Belgium appears as a buyer, it often masks the activity of other central banks and institutions seeking anonymity. Rising Belgian holdings alongside Chinese selling point to coordinated support rather than independent investment decisions. This arrangement functions only while allies retain capacity. Unlike China during its export boom, Europe and the United Kingdom face slow growth, aging populations, and heavy debt burdens. Every dollar diverted into U.S. Treasuries is a dollar not invested in domestic infrastructure, energy security, or social stability. The system therefore grows fragile. If an ally faces a currency crisis or domestic shock, it may be forced to sell. When that happens, the artificial bid disappears and the imbalance. This fragile arrangement creates a dangerous game of attrition. Every $1 billion of U.S. Treasuries that China sells forces the Western financial system to find $1 billion of liquidity to replace it. That liquidity does not appear from nowhere. It is pulled away from productive uses such as factories, infrastructure, innovation, and domestic investment. Capital that could generate growth is instead consumed by refinancing existing debt. China understands this dynamic. By steadily selling, it is not trying to crash the market overnight. It is draining the system slowly, testing endurance. The longer the process continues, the more pressure accumulates on allies already struggling with weak growth, high debt, and energy transitions. This is economic warfare by exhaustion rather than shock. Unlike China's earlier role as a price-insensitive buyer, today's replacement buyers are politically constrained. They cannot absorb unlimited supply. They buy until voters react, currencies weaken, or domestic crises emerge. Political buyers are inherently unstable because their participation depends on tolerance, not profit. This marks a structural shift in the bond market. What was once a global reserve asset supported by economic incentives is becoming a regional asset supported by diplomatic necessity. The pool of buyers is shrinking while issuance expands. That imbalance defines the risk ahead. Another transformation is occurring beneath the surface. The proceeds from selling bonds are being converted into physical stockpiles. When a U.S. Treasury is sold, settlement delivers dollars. Those dollars are traceable, sanctionable, and vulnerable to inflation. Beijing's response has been to exchange paper claims for assets that sit outside financial custody. Gold sits at the center of this shift. Official purchases have continued for months, while exchange withdrawals imply larger accumulation through intermediaries. Gold carries no counterparty risk, cannot be frozen by payment systems, and functions without permission. Moving reserves from credit to collateral reduces exposure to legal reach. Energy is the second pillar. China imports most of its oil, a strategic weakness in a conflict. To offset it, state firms have filled strategic reserves, buying from discounted suppliers and expanding storage onshore. Stockpiles convert cash into time. Metals form the third pillar. Despite a depressed property sector, imports of copper, lithium, and rare earths remain high. These inputs power grids, vehicles, drones, and munitions. Holding them yields no interest, but it guarantees capacity. Finally, food. Grain reserves have been built to extraordinary levels, trading yield for calories. The pattern is consistent. Sacrifice financial return today to ensure survival tomorrow. This shift marks the end of an era for global investing and risk management. For decades, U.S. Treasury bonds were treated as the ultimate safe asset. They formed the backbone of central bank reserves, pension portfolios, and the classic 60-40 investment model. Bonds were supposed to offset risk, stabilize portfolios, and provide certainty during crisis. That assumption is now under direct challenge. When the second largest historical holder of treasuries treats them as a strategic liability, the definition of safety changes. Bonds no longer represent neutrality, they represent alignment. Ownership now carries political exposure, legal risk, and dependency on goodwill. Safety has become conditional. This does not mean treasuries collapse overnight. It means their role is changing. The market is no longer dominated by economic buyers seeking yield and liquidity. It is increasingly supported by political buyers acting out of obligation and coordination. That distinction matters because political demand is fragile. It can reverse quickly when domestic pressure rises. As issuance expands and the buyer pool narrows, volatility becomes structural rather than cyclical. Stability requires constant intervention. Without it, yields must rise to clear the market. The bond market becomes a managed space, not a free one. This is why the sell-off matters. It signals a transition from trust-based finance to power-based finance. What comes next is not collapse, but a forced adjustment that most investors are unprepared for. When a market loses its natural buyer, it does not disappear. It changes character. Prices stop reflecting confidence and start reflecting pressure. That is what is happening to the U.S. Treasury market. It is no longer clearing through voluntary demand. It is being held together through coordination, intervention, and political necessity. This creates a dangerous asymmetry. Debt issuance continues to expand, driven by deficits that cannot easily be reduced. At the same time, the group willing and able to absorb that debt is shrinking. When supply grows faster than genuine demand, stability becomes artificial. It must be defended continuously. The moment one major support pillar weakens, the adjustment accelerates. That is why attention must shift from interest rate announcements to flow data. Watch who is buying, who is selling, and who is being forced to act. Those movements reveal stress long before prices do. China's exit is not a trade. It is a signal. It tells you how a system insider views future risk. When insiders leave quietly, outsiders should ask why. The bond market has become a strategic battlefield. Ignoring that reality is the most expensive mistake ahead. This is why none of this should be dismissed as abstract geopolitics or distant macro noise. What you are watching is a structural shift in how power, risk, and safety are defined in the global financial system. When sovereign debt becomes a tool of leverage instead of a neutral asset, the old assumptions break. Stability no longer comes from diversification alone. It comes from understanding flows, jurisdictions, and incentives. China is not acting emotionally. It is acting methodically. It is exchanging paper promises for physical control, trading yield for survivability. At the same time, the West is stretching its own balance sheets to delay adjustment. That delay creates the illusion of calm, but it also builds pressure. Artificial stability always fails suddenly, not gradually. For investors, policymakers, and ordinary savers, the lesson is the same. Stop relying on narratives. Start watching behavior. Follow custody, settlement, and flow data. Pay attention to who is forced to buy, not who claims confidence. That is where stress reveals itself first. This is not about predicting dates or panic scenarios. It is about positioning for a world where financial assets are no longer insulated from politics. If you want to stay ahead of that reality, keep learning how systems actually function beneath the surface. Stay alert, watch the flows. The protocol is active.